Welcome to this video on the performance of a multi-factor portfolio. After completing this video, you will be able to explain why a detailed analysis of portfolio returns is needed, and you will also be able to interpret the returns metrics to understand the performance of the portfolio.
Mary, the capital invested in this factor tilt portfolio grew by 95% from 2020 to 2024. Can we consider this as a portfolio with good performance?
The high returns don't guarantee good performance. In addition to cumulative returns, you would need deeper analysis to study the consistency and stability of these returns.
Mary, what exactly should we be looking for when we perform this analysis?
We can start by understanding how the components of the portfolios contributed to these returns. For example, we can perform both factor-level and asset-level return analysis. In addition to that, we would also need to study the risk of this portfolio in depth.
Could you give an example of this returns analysis?
Let's start with understanding the factor weight distribution. Here is the distribution of weights for your portfolio, and as you can see, on average, per day, we are giving more than 60% of the portfolio weight to the growth factor. Let's look at capital allocation from a different viewpoint, from an asset perspective. About 48% of the capital was allocated to a single ETF, IWY, which belongs to the growth factor. This is the first red flag in the portfolio.
What are the issues with allocating weights in such a manner?
This would lead to concentration risk. Allocating more than 60% weight to the growth factor, in cases where the economic cycle changes, and where the growth factor underperforms, would greatly affect the returns of the entire portfolio. Similarly, by allocating more than 48% to a single ETF, which is IWY, we are opening doors to a scenario where the underperformance of one ETF can again greatly affect the overall performance of the portfolio.
How do we avoid this concentration risk?
This can be avoided or controlled by diversifying the capital across the factors, or the assets involved.
Mary, my objective was to tilt my portfolio towards the growth factor, and diversification would negate this tilting effect.
In such a case, you can limit the percentage of weight to a threshold so that this extreme case of allocating 60% to the one factor would be avoided.
Is there any other analysis we need to do to understand the performance?
In addition to the analysis of factor and asset-level returns, we also need to study the distribution of returns.
Why do we need to study the distribution of returns?
It will give an idea of how consistent and how stable the daily returns for the portfolio are.
Can you give an example?
This is the histogram of the portfolio's daily returns. As you can see, the daily returns are 0.06%. Even though the mean daily returns are small, consistent mean daily returns could add to the cumulative growth of the portfolio. On the other hand, there are two extreme scenarios where on a single day the portfolio made a loss of more than 9% and a profit of more than 11% on another day. But we can get a better understanding of the behavior of the portfolio from skewness. Here, the skewness is on the negative side, which is minus 0.27. Even though the skewness value is small, the negative value indicates that there are more chances of getting negative returns than positive returns. However, since the value of the negative skewness is small, you can conclude that there are higher instances of smaller losses than smaller profits, or larger profits. Finally, we can also see the kurtosis value of 10, which is extremely high. This indicates that there are presence of fat tails on either side of the mean. This would suggest that in terms of major events in the market, there are chances of extreme losses or extreme profits, which can in turn increase the volatility of your portfolio returns. To summarize, on the positive side, the mean returns are modest but consistent. On the negative side, there is extremely high kurtosis, which increases the risk of extreme drawdowns in terms of market stress, and small negatively skewed returns distribution, which indicates that there are high chances of smaller losses than smaller profits, or larger profits.
Mary, how do we reduce these risks?
As discussed earlier, These risks can be reduced by diversifying or limiting the weightage to a specific factor or an asset.
How do we perform in-depth risk analysis?
This can be done by studying the drawdowns of the portfolio and also understanding how the portfolio performed during stressful events in the market.